Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up, we lead the show with grocery. We transition from there into actually branded sports retail. We'll talk about a new Major League Baseball store opening up in New York City. And we'll also talk about imports and a potential swell of imports in December ahead of projected December 15th tariffs. A reminder to like us and rate us wherever you do find us. You can also check us out on Instagram at Retail Podcast and Twitter at the same handle. Just a quick note here, in the past, it's been my fault for not recording regular episodes because I've been traveling. In this case, Leighton was sans voice earlier this week, so we didn't get to record an episode until this weekend, Saturday, October 19th. So we've updated our content a little bit. And the main thing we updated here was a big earnings call that came out this week. And no, it was not for a publicly traded company. It was for the still privately held Albertsons, and it appears the momentum for them is real as the company sees a surge in its second quarter earnings. Now, on the show, we've been openly ambivalent about Albertsons, saying, they have room for growth. The growth is there if they want it. But they've also let some of their store base grow stale, and they don't bring a real proposition to the consumer to the table in several of their markets where they can't compete on price with the likes of Kroger and Walmart and are struggling to compete on convenience. And that goes with fresh offerings as well, the grocerants in their store. And in particular, we've kind of seen them struggle over the last 4 years with the full integration of Safeway. Even though they do have a string of positive comp sales, it's been mild positive comp sales, and ultimately they're attempting to kind of balance development with the need to just tread water under a significant debt load. Most of that, of course, coming from the Safeway deal. But as I mentioned, momentum continuing with this previous quarter here, and as the numbers came out, we were both pretty impressed with what Albertsons now is bringing to the table.
As we've discussed so often in the past, they are still a privately held company, although they've had aspirations going public after several aborted attempts in the past 3 years. And they still really want to be able to raise capital, as Trent had mentioned already, to pay down some debt. As such, we don't get a full look into their balance sheet because they are still privately held, and the company can be selective about the information they give to the public. That said, we are extremely grateful for what we do get provided with. This has the result of more positive than negative news overall being produced in their quarterly releases and in local or national news outlets, again, because they can control what gets out to the major retail media. So take the positivity with the grain of salt. But diving into these numbers, you can see that the number that caught the headlines in Boise newspapers, as well as national outlets such as Supermarket News, was their net income. They transitioned from a loss of $32 million in 2018 second quarter to a positive $294.8 million this year. Granted, they saw a number of negative impacts in last year's second quarter. It was noted in their release, from the Rite Aid merger attempt with some lingering legal fees out there. Even still, the number was a huge swing, and the magnitude of the net income amount caught a number of analysts by surprise, including, of course, us. According to the company, a main reason for the profit growth was their continued development of private label brands in store, and this is something that is going to be a theme not only throughout this story, but every other grocer in the United States really trying to grow their private label brands. They have been consistently focused on honing their private label brands over the past 4 years, experiencing some difficulty in attempting to properly leverage the private label brands acquired from the aforementioned Safeway deal. They doubled down on a private label brand refresh this May, in fact, endeavoring to align most traditional store products under the Signature Select brand rather than being split under multiple brands, including Signature Kitchen, Signature Home, Refresh, and the Snack Artist. This, again, is a movement that we've noted from many grocers, not named Walmart or Kroger lately. Target was one of the most recent with their rollout of Good and Gather. This was something we talked about here on the podcast. That was designed to take the spot of Archer Farms and other store labels as a form of really brand consolidation. In particular, The Signature Select brand was a private label brand acquired in the Safeway deal, and Albertsons opted to adopt it chain-wide rather than leaving it isolated to Safeway-branded locations. I think that's an interesting move. They obviously saw value in that particular brand. They said in this second quarter that 25.3% of purchases included a private label product. Not a huge number for a grocer in itself, but a number that is certainly growing over what we've seen in the past. In addition, Trent, to consolidating multiple brands under a Signature Select banner, they've worked to include more premium level products in their private label offerings, something that Kroger has long done with their private selection line. Other current private label brands Albertsons offers in-store are their O Organics line, which has also been relentlessly expanded as of late because of that demand there for organic offerings. Open Nature, mostly refrigerated goods there, and of course their dairy-based line Lucerne. Another big reason for their margin growth in this quarter, according to the company, has been their digital initiatives. Again, we don't necessarily get the full picture here with Albertsons, but this is again the grain as far as we've seen from Kroger and Walmart, whose margins have been said to have shrunk as a result of digital sales. That said, Target's margins in grocery are said to have gone the other way with increased touching of digital channels as a result of greater product turnover and less spoilage, by the way, and necessary discounting in some particular areas. And you see here, this shrink spurred by digital investment might be a major driver behind increased margins for the company. The company noted improved shrink expense as a major reason why gross profit margin increased 30 basis points over a year ago. As with everything else, we've seen Albertsons be significantly behind their competitors in adoption of digital options in their nearly 2,300 stores, but that seems to be taking a turn for the better as of late. As an example, we've seen a lot of growth of online home delivery and their drive up and go programs of 40%. By the way, Trent, we should say, as with everything else we do with these stories, we have to mention all of the banners. So it's not just Safeway that they own. Albertsons owns a number of different banners. Of course, they acquired Plated as well, but they own Pavilions, which is a prominent grocer in the Southern California market that I'm closest to, Lucky Brands, Star Market, Shaw's, and of course, Jewel Osco, Acme, Amigos, and the list goes on and on. But that would encompass those over 2,000 stores that I just mentioned.
Yeah, adding to those, you've got banners like United and Market Street in the Texas area. Also, Tom Thumb, Randall's out there as well. But you were mentioning digital initiatives, and in addition to those digital initiatives, we've actually seen slight traffic growth in the stores as well of late. Anecdotally, in addition to that traffic growth, or maybe spurring that traffic growth, it's the addition of self-checkouts in many older locations that didn't have self-checkouts prior that's helped to maybe drive traffic incrementally. Now, we've talked in the past about the widespread negative perception around their front-end experience, multiple media outlets being critical of their throughput capabilities, but this was something you even saw leak into stand-up comedy routines where people would describe a Safeway from hell where there's always longer lines. And despite their Three's a Crowd initiative throughout their store base, it seemed as though this was rarely followed in the locations without the self-checkouts. So I made 20 visits to Albertsons or Safeway stores across 4 different states within a year period of time. And each one, because I was aware of this Three's a Crowd initiative, I observed lines greater than 3 people 18 times. So a full 90% of the time, basically, you're seeing lines greater than 3 people, which is, again, against their company optimization goal. And only observed a Three's a Crowd call coming from the front-end associates twice. So basically, from that small sample, the initiative was only being followed around 20% of the time. And I should mention, these are in locations that didn't have the self-checkouts available at the time. However, by investing in self-checkouts in some of these older locations, Albertsons has helped to alleviate that stigma of poor front-end experiences, particularly in areas outside of their Boise base. Most of those stores already had a self-checkout experience, and you look anytime you see stores around a company's home base, you look at Kroger in Cincinnati, you look at Walmart stores in Northwest Arkansas, you're going to see those stores trying out new things, but also be more technologically innovative around that store base, which we'll talk about with Boise here in a second. So if you're listening in the Boise area, you might be saying, well, this is crazy because Albertsons stores are always well kept around where we're at. They all have restaurants. They all have self-checkouts. They've got an incredible front-end experience. Yeah, but that's not necessarily the experience that a lot of customers have in the rest of the country outside of that metro area. But when we look at just the in-store technological investments for this quarter, we see that it significantly offset margins, as did their digital channel investments. So even despite the fact that they were much more profitable in this quarter over last year, they still put forth $716 million in total CapEx year to date, so inclusive of the first and second quarter so far this year. And again, that's for the in-store technological developments, it's for digital channel investments, and we're seeing those pay off in very real terms for the grocer. Other positive news surrounding Albertsons in the second quarter was comp store growth. It came in at 2.4%, which outpaces inflation in the sector over the same period of time. This was their 7th straight quarter of comp growth, although it was a more substantial showing than some previous quarters. We would see comp growth lagging inflation slightly. It would come in at maybe 0.5% or 1% for Albertsons. This was their largest comp store increase in over 3 years. So that's why we're talking about it here. It wasn't slight. It was a big jump for a company that struggled to put up some of those positive numbers in comp store sales when compared with inflation. Sales as a whole across the chain increased 1.1%, and of course, that's less than the growth in comp sales that you're seeing of 2.4%. This is a direct result of their stores closed in the last year as they continue to optimize their store base. Even 4 years after the Safeway deal, they are selectively closing some underperforming stores or some stores that are cannibalizing other stores in particular markets. Now, as far as company pressures or pressures on the grocer are concerned, there are some reasons why it might not be all positive in this past quarter for Albertsons. Harkening back to a story we actually referenced about 6 months ago on a podcast, there was a really interesting study produced by CBRE, but Albertsons is finding rent expense for their distribution centers to be increasing. So we talk about rent expense oftentimes increasing for retailers, particularly retailers of Albertsons size in shopping centers and the like. But in this case, they actually talked in this release about rent expense for their distribution centers to be going up. And specifically, when we talked about this 6 months ago on the podcast, we talked about how basically cold and grocery storage facilities in the U.S., inventory of those isn't keeping up with demand. So there just aren't that many cold storage centers in the U.S. compared to where the demand is for grocery and also for some of the digital grocery platforms. And this is as a result of the massive upfront costs associated with building these facilities. Building refrigerated facilities takes specialized knowledge, and that's something that only 2 or 3 firms throughout the U.S. have a lot of, as we see kind of an oligopoly in this area. So the fact that Albertsons doesn't own and operate their own warehouses means that you're going to see that increase because of inventory. And that's what we said 6 months ago on the podcast is the likely result's going to be increased rent costs for those that rent the cold storage facilities. It's not just grocers, but also grocery merchandisers, warehousers, that type of thing. And exactly what we're seeing with Albertsons in this quarter. The company doesn't seem to have any intention of constructing their own facilities in the future. So that being said, going forward, we can expect the potential for distribution center rent increases in future quarters as well. Another thing to note is oftentimes when you look at store rental agreements, you're looking at 20, 25 years for grocers like Albertsons, Safeway, Kroger on those rental agreements. Distribution centers often tend to not have that lengthy of a lease, or when they do, you see more frequent rent bumps. So something to keep in mind there as their balance sheet is concerned. Another not so positive thing mentioned in the earnings report was reimbursement rate pressures in pharmacy, which is another thing that we can expect to see on a wider scale as we continue to see pharmacy consolidation. The bigger pharmacies with more locations can endure more as far as these reimbursement rate pressures. Albertsons has around 1,700 pharmacies, or about 76% of their store base with those pharmacies inside them. It would have, of course, been larger had they made that purchase of Rite Aid or that merger with Rite Aid that had been proposed, but didn't go through, so they've got 1,700 now. You compare that with the other industry players. 9,500 pharmacies Walgreens still owns, even after the recent closings. The nearly 10,000 CVS pharmacies, not to mention all the pharmacy locations throughout the country run by Walmart in both their full-line stores and the neighborhood markets. These pressures are going to weigh more heavily on pharmacy outlets that lack the sheer scale in terms of that reimbursement rate. So these are two things that we're probably going to see not only in this previous second quarter, but you're probably going to see it in future quarters as well.
A couple of final quick notes worth discussing about this story. First, there are some macroeconomic factors benefiting Albertsons currently, most notably the decrease in current interest rate levels. For a company that is so heavily debt leveraged, by the way, they have a net debt leverage ratio of 2.9 times, which is down from prior years, but it's still fairly large. This can produce major savings looking at their amount of debt. As such, they went about repurchasing $1.5 billion in outstanding notes, issuing a new $750 million offering at a much lower interest rate. So as you see the federal funds rate being decreased, this helps oftentimes companies that are in a bit of a pickle right now. So companies that you see actually issuing bonds, they're doing so because they can have a lower effective interest rate because of the current market. Overall, between their reorganization of notes and reduction of debt level, they were able to shave interest payments by over $15 million in the quarter, net of reorganization fees. Of course, you have those administrative fees, the refinancing fees that are along with that, but overall savings is impressive for the company. And the second thing worth noting, Trent, for this little bit, and this was separate from the earnings release, by the way, but Albertsons is one of the companies piloting the Bossa Nova robot in stores. This robot, the Bossa Nova robot, also being piloted at Walmart, roams throughout the store and works around customers and associates. Basically, it uses 3D imaging to track product and potentially incorrect pricing throughout the store, like a sales tag not having been removed, for instance. Currently, the robot is in 3 Albertsons locations in the Boise area. Of course, it would be in the Boise area, but could be rolled out to additional stores as the technology is honed for the company's different needs. Anyone who has worked in retail can confirm there is likely a need for this, and as inventory tracking systems have been less than precise in the past, and this isn't a task that associates can typically do on this scale or efficiency. Traditionally, tag maintenance is done by overnight crews or evening employees, but even then, no one has the time to really available to check tags for accuracy. That said, the design of these robots isn't to replace human labor, but rather to do a job that too often isn't done with the current staffing levels provided. Let's just hope that these work out better than the egg-shaped police robots, which have done things like run over pedestrians and things in the past. We'll transition to our second main story for this edition of the podcast this week, and we'll go back to the National Retail Federation for the news this week as they produce research that suggests retailers are once again stockpiling imported goods ahead of expected tariffs. These findings come via Port Tracker report coming from the NRF and Hackett Associates. As we've discussed before on the podcast, and as many analysts have actually pointed out, it appears as though retailers are leveraging any unused warehouse space to broker deals for merchandise from China prior to the next set of tariffs slated to take hold in mid-December. Although Jonathan Gold of the NRF notes that part of this effort is an attempt to mitigate perceived impacts on holiday shopping. It is likely that retailers would have purchased most of their holiday goods by this point. It is very astute of Jonathan to point out. This is in fact noted by the NRF later in the survey release. Most apparel and home goods retailers, for example, have already integrated merchandise for the holiday season in their back-end warehouses. So some general merchandise retailers might otherwise be impacted by the slated December 15th increases in time for the holiday season. But again, with the average supply chain turnaround, any impacts would actually be slight. Instead, this appears to be an effort to mitigate tariff impacts in the first quarter of next year by many retailers. All that said, Trent, taking a look at the study, it is clear that there is expected to be a surge in imports ahead of the December tariffs, just as we've seen before with other scheduled tariff adoption.
Now, import volume is often measured in 20-foot equivalent units, or TEUs, which basically covers one 20-foot cargo container. And most of us have seen these cargo containers, whether on the back of semis, on ships, on railroad cars. That said, numbers from the Global Port Tracker suggest a forecasted increase of 8.9% year over year in November for U.S. ports. That puts it up to 1.97 million TEU. Now, this follows year-over-year declines in October of 5.1% in terms of volume as new tariffs took effect in September. Thus, the theory goes, causing those declines the next month. Speaking of those September tariffs, they were also the likely cause of a 3.9% year-over-year increase in August, something retailers referenced on earnings calls at the time as product sourcing teams scrambled to try and stockpile before that particular tranche of tariffs was implemented. Now, after November, a year-over-year decrease is expected once again in December, this time of 9.3%. We can see here that the main effect tariffs seem to be having, at least right now, on overall U.S. imports is a clustering of activity as retailers attempt to find ways to cope with the tariffs by purchasing large amounts at one time before the tariff tranches come through. And a lot of retailers tend to either wait until the last moment just to make sure the tariffs are going through, as we've seen a lot of retailers take a wait-and-see approach. But the other thing is, a lot of times ordering is done months in advance, and so you're really asking of your sourcers to produce more product if you're going to order ahead of time. So that's why we've seen just a little bit of delays. So you might be saying, like, well, why weren't they stockpiling in October for this tranche of tariffs coming in December? A couple of different reasons there. Now, it's worth noting that these numbers measure overall U.S. port activity. So we're not just talking about goods coming from China. We're talking about goods coming from all potential countries that are exporting goods, and we're importing them into the U.S. Now, as far as expectations for next year, this study released that it's anticipated we'll see year-over-year drops in both January and February of 2020, looking at down 1.9% and then 1.8% respectively. You see a little bit more of an evening out of numbers. And the reason we're bringing this up at all, since many of these impacts are understandable, has to do with retailers' ability to cope in the short term in order to squeeze out margins. There are certain retailers that are out there, most notably the off-pricers, that have been very clear in earnings calls to this point that they have pack-away space to make deals in advance of the December tariffs. However, other retailers who are maybe in the midst of building distribution centers to scale up their operations because they need their operations basically to grow to their store count, those might be in rougher shape, and one such retailer is Five Below. Actually, when we go back to Five Below's last earnings call, they talked about kind of a feverish acceleration of changing their product sources away from China as a way to mitigate impacts. Also, they have discussed, of course, about increasing their top price points, which is something that's been discussed by analysts and the company itself over the last year, and they're discussing this as an alternative to stocking up. Since they're in the midst of attempting to scale up their distribution capabilities, they have plans for 3 more distribution centers, it's said, over the next few years. So when you look and say, hey, their store base right now, their DCs can barely keep the store base stocked as it is. They have plans to increase their distribution capabilities. They're not going to have that same pack-away space as other retailers. So as a result, they're trying to adjust in a different way than some of the retailers might be, at least suggested by this study. Interestingly enough, struggling apparel retailers are the ones most likely to have additional warehouse space if they've culled their inventory, clearanced it out, like what JCPenney, for example, has done, in order to accommodate an expected flush of orders from November and early December before those tariffs take effect. However, on the other side of that, you also have to have the capital in most cases necessary for these type of purchases, or have strong credit agreements, which is something that maybe not all struggling apparel retailers have.
One other thing of noting in this release is the expected impact on consumers as the calendar turns to 2020. Ben Hackett, founder of Hackett's Associates, was quoted in this release by saying that any meaningful slowdown of imports will be seen next year, and that this is when the full impact of the tariff wars will be translated into a consumption tax felt by consumers. There seems to be some disagreement about whether tariffs will be passed on to the consumers or absorbed by the companies doing business. But when in doubt, assume that the companies aren't likely to fritter away margins unless necessary to compete with other retailers. That said, Trent, stocking up on product in an effort to stall tariff impacts can only help for so long. Eventually, retailers will have to decide to what extent they will either have to pass on prices to the consumers, absorb tariffs and take a margin hit for the longer term, or move sourcing to other countries or areas. And this is something we've already seen with the likes of some companies we talked about on the podcast, such as lumber liquidators. So given what we've heard on earnings calls, it sounds as though retailers have very different approaches to these three levers and how they will adjust each to determine profitability in 2020 and beyond if tariffs stick around. But there is one fact, Trent, there is one objective measure you can take away from all of this, and that is, for those publicly traded companies, shareholders hate uncertainty. They want to be able to know what the tariff levels are going to be and what strategies each individual retailer are going to use to try to fight against these negative margin hits. Well, we move on to a segment of the show that we are now introducing in 2019 here and there, not all of the time, but it's a little fun for us as we travel a lot, Trent and I. So this is the portion of the show where we discuss what retailers we visited recently. And Trent, I haven't visited anything except for a North Hollywood Kmart that is closing, and that was just sad. So I don't want to bring our audience down. So for this week, we will transition to you for your recent travels around the country. And I believe you visited 2 malls?
That's correct, yeah. So I've been a lot of places over the last couple of weeks. I was actually in LA, got a chance to see Leighton in person there for a little bit, but I've been to also Dallas and Salt Lake City, and these are the 2 cities that I want to talk about because I visited a mall in each city. So we'll start with the Dallas Mall first, or the Dallas area mall first, I should say. Grapevine Mills Mall is just north of the DFW airport, and I actually went originally about a couple of years after it opened, which would have been 20 years ago. It opened back in 1997, went to the mall for the first time in 1999, went back several times after that, and really when you talk about the mall, it was kind of not necessarily the height of luxury as far as shopping malls were concerned, but it was a bustling, robust mall, lots of full-price stores in there. And it's been about 10 years since I've been back. But the last time I was there, they were struggling a little bit to keep tenants. Well, this time I went and I was very impressed. First of all, this mall, the way it's built, it's got a lot of experiential aspects to it. There's an aquarium there. There's a Lego facility there as well. So lots for kids to do. There's a couple of play areas. There's also a round one in there, which is something that you're starting to see in a lot of different malls there, kind of a bowling alley arcade combo. So they had the experiential aspects for sure. But what impressed me is that there were now a lot of outlets in the store compared with prior years. And also in some of the anchor spaces, there were actually off-price stores. Believe it or not, Leighton, there's a Sears outlet there that's selling things like lawnmowers, for example. There's a Burlington. It's probably the largest Burlington I've been in. It had to be at least 70 to 80,000 square feet, at least the largest Burlington I've been in some time. There was a Ross store there. There's a Marshall store on the complex, but also a number of outlet stores. And so you had this interesting situation where you had the outlet stores existing right next to some higher-end retail stores, for example, a Swarovski Crystal location. But the end result is a very high occupancy rate. I walked the entire mall. There was only one small store, maybe about 2,000 square feet, that wasn't occupied. Everything else was occupied. So it's an occupancy rate that's got to be close to 98 or 99% because all of the anchor spots were occupied. All of the food spots were occupied. There were even quite a few local stores in there that were occupying spots within the mall itself. But the other thing was that I visited at 11 a.m. on a weekday. So again, kids are in school, K through 12 kids are in school, a lot of people are at work, and yet this mall was incredibly busy. You had a lot of stay-at-home mothers with children younger than 5 years old. You had a lot of grandparents with children under 5 years old, taking them out to this mall to shop and experience some of the other aspects, like, for example, the Lego facility there. You had a lot of other people that were just out and shopping. I was amazed from the moment I walked in at how busy and bustling the mall was. And the customer base was spread throughout the store. So if you walked into a Ross, there would be a lot of people in the Ross. There were people in the Swarovski Crystal Center. There were people in the Bath and Body Works. There were people everywhere throughout the mall, and it was highly populated. So we give Simon a bit of a hard time in this podcast for not adjusting some of their facilities. And the fact is that a lot of what were once A-class malls have fallen into B or C-class range. Simon has done a great job not letting this happen with this property. As such, they're enjoying that full, complete retention of retailers there, the very high occupancy rates overall, and they're keeping traffic coming to the malls. This appeared to be a place where people wanted to go, that people sought out, even though it was 11 a.m. on a weekday. Now you transition that to my experience in Salt Lake City, and actually I was in kind of the outlying areas of Salt Lake City, so in the West Jordan area, and I went to the shops at Southtown. Now this is a very nice looking complex. It's a little bit more recent looking in terms of architecture than its cousin. You can't really call it a cousin. They're not owned by the same company. This is a Pacific facility in this case. But then the Grapevine Mills Mall was lots of glass used, lots of mountain overlooks, that type of thing. But same day of the week, same time of the week, 11 a.m. local time. And this mall was nearly deserted. And the difference between the two is the closest thing to an off-price or outlet store this particular facility had was a Home Goods. There was no TJ Maxx or Marshalls or Ross or Burlington or anything like that. Instead, they have tried, it seems like, to cultivate maybe what is considered, in scare quotes, if you will, a higher level retailer. But as a result, about 80% of the stores were what I would classify as kind of undifferentiated fashion retail. You have the traditional fashion standbys, the Aeropostales of the world. There was a Forever 21 where they had a lot of sale racks just completely empty. A lot of the store was empty there. It almost looked like a Sears circa 2 or 3 years ago, the Forever 21 did. And then you had other larger anchors like JCPenney and Macy's that were completely deserted, and all of them are alongside the traditional likes of Maurice's and those type of retailers, but also a number of local or regional chain retailers that again were selling apparel. And there was just no one at that mall to be able to take advantage of any of the deals, to be able to take advantage of any of the things offered by these fashion centers. As a result, there were some experiential aspects to it. There's a Round One location there as well, but not nearly to the extent that Grapevine Mills has. You saw this mall be mostly empty, but certainly occupancy rates reflected traffic. I would say about 30% of the mall was not occupied. That's not to say it's a dying mall, certainly, as a lot of the retailers were still there, but there was an anchor spot that wasn't occupied. There were several stores that had moved around and left empty locations and empty spots. So this is a mall that really has to do some soul searching and figure out if that pivot to where you're combining off-price and outlet step by step with some of the higher end fashion stores that aren't driving in the traffic, if that's something that perhaps they should go to in the future, because I think you would classify this as a Class A property. It's in a gorgeous neighborhood. It's in an area where, generally speaking, people have a high amount of disposable income. But the busiest store there, actually the Bath and Body Works. There were about a dozen people in that store, which is more than were in the entirety of the Macy's or JCPenney, probably more than in JCPenney and Forever 21 combined. So when that's your main draw, I think it's really up to that REIT, to that ownership company, to figure out how they're going to reorganize the structure. They've got space there for more experiential aspects of it. The key is just attracting those tenants and finding something that's going to bring people in, because right now, apparel isn't that main traffic driver. And when, like I said, by my estimate, about 80% of the stores are strictly apparel-based stores, and there's not a lot to differentiate one from the other, it's not looking good for that particular mall.
Well, Trent, I would say that you have a lot of good insights into how malls can either transition or the malls that decide to remain stagnant as to why they're having problems. But I will say that I'm jealous that you have the time or the ability to travel to even visit these malls in these different municipalities. I wish I had a job that afforded me that same right. But we move on to our last major news story of this edition of the podcast. We're going to be talking about sports. We're going to be talking about apparel. In particular, we're going to be talking about also a Major League Baseball announcement where they plan to build out a New York flagship store. But this story comes via the news outlet Front Office Sports, who also provides us with a look inside the state of logo-branded sports retail. The reason we discuss this is not solely because of the opening of the single retail store, which in and of itself would be pretty much unremarkable for us on the podcast, but the fact that the MLB is making this play in a comparatively weak environment. Let me tell you the details here. The article goes into a lot of specifics as far as the current state of licensed apparel, using information from the NPD Group. The NPD Group tracks revenue produced by official league distributors, which includes the two big distributors in Dick's Sporting Goods and Fanatics. Fanatics running a lot of commercials as of late trying to promote their licensed apparel lines, but also the likes of regional distributors such as Modell's. Over the last 12 months, Trent, the NPD says that the sale of MLB licensed merchandise is actually down high single digits. Things aren't great for other sports leagues either, with the NBA sales reporting flat and NFL sales actually down low single digits. As far as the NHL is concerned, it's pretty much a mix, but it really does depend on each individual team. Canadian teams in particular don't see much change in sales year over year. However, in the U.S., the trend, like we just noted with the NFL, is generally down. The conundrum is the fact that sports apparel is actually a really strong category right now. We talk about this a lot. If there's one apparel category that is doing very well, you look at those brands such as Nike, Adidas, Puma. However, it is not translating well into licensed apparel sales. So note the difference here. And the difference here is the fact that licensed apparel will generally feature a team's logo or a player's name, likeness. So in this particular case, athletic apparel, such as that which is bearing a manufacturer logo, is actually doing quite well in the retail space. But apparel with a team logo actually is not. And that's very, very interesting for a number of reasons. As Matt Powell, senior sports industry advisor at NPD Group, says, you'll see fans wearing licensed apparel in a stadium, but not in the street. And Trent, I will have to say that seems anecdotally to be the case. I remember growing up in the 90s, I don't want to date myself, but people used to wear sports apparel from regional sports leagues all of the time. And now that's just not the case. If you go to a local gym or you go to a sports track, everybody's wearing a Nike shirt or an Adidas shirt. It is very much branded to those major brands such as Nike, Puma, Adidas, etc., not sports teams. The article goes further to point out something we've talked about for a while on the podcast, actually. New York City flagship stores of most types aren't profitable. So this is something of note, particularly league-based stores.
With any retailer, and we're not just talking about retailers in the sports space here, it's more of a move about visibility or marketing, as Powell, who Leighton quoted in the article, had put it. The NBA and NHL already have stores in close proximity to the new MLB opening, which will be across the street from Radio City Music Hall there. Major League Baseball's SVP of Consumer Products, Dennis Nolan, notes that MLB's current stores are mostly located first across Asia, and then they also focus more on lifestyle or fashion enthusiasts, which suggests that we could potentially see the same from the New York store, even though Major League Baseball says they want to make this an experience more than just a retailer. He notes that in these particular stores, it isn't the importance of the logo, so it's not about team alignment, but rather the importance of the design that will draw customers in. And this is actually something, in talking to various members of the Dallas Stars organization in the NHL, they really tried to make a complete change about 5 years ago in terms of merchandising and in terms of creating their products. They went a little bit independent with some, so they didn't just align with Fanatics or Nike or Adidas. They tried to come up with different designs that were going to appeal to people who wanted to wear it on the everyday. It wasn't so much about showing that you were a Dallas Stars fan. It was more about making the colors, about making the logo cool, about bringing that identifiability in. And with Major League Baseball, you do have some franchises, the Los Angeles Dodgers, the New York Yankees, the Boston Red Sox, that have that logo capability, I think you would start to maybe lump the Houston Astros in with that as well, now that they've been pretty good over the last few seasons. But one thing that we'll note is that it looks like Major League Baseball wanting to do even more of this and wanting to push more of those Major League Baseball logos kind of to the forefront of the public in terms of thinking about fashion. Now, all that being said, they are fighting an uphill battle. And for evidence of this, I go back to the malls that I was just talking about. So each of those malls, both the Grapevine Mills malls and the mall in South Jordan, had Lids stores in them, as well as Fans stores in them. So a couple of different outlets there. They're both owned now by the same company. But I say that to say this, that Genesco was pretty much pressured by its shareholder base to divest Lids because compared to the other retailers within its organization, it was really dragging the company as a whole downward. In fact, looking at the second quarter of fiscal 2019, Lids had negative same-store sales of 5%, when Journeys, one of the other categories that Genesco offers, was up 10% in those same-store sales. And those same-store sales drops continued to happen for Lids. Now, Lids is owned by kind of a separate firm. It's a privately held firm. Part of Lids, technically, or a minority share of Lids and Fans, is owned by Fanatics, in fact. So it kind of brings it back full circle. But as I mentioned, Lids was falling year over year in terms of those same-store sales because team logo apparel just wasn't popular. And I think a few different reasons for this. One is, of course, the fashion reason that Leighton already mentioned, but the other is if you were to buy a hat with simply just a Nike or Adidas logo on it, it's probably going to be a significant amount cheaper than buying a hat with a team logo on it. And part of that is because of licensing agreements, because of league agreements. You throw in more middlemen, and so that price is going to be higher. So if someone walks into a store and they have a choice between a Dodgers hat priced at $40 and an Adidas hat priced at $20, they're probably going to choose the latter if they just need a hat that's a particular color or to fulfill a particular ensemble that they've got. Or if you're just looking at hats from strictly a utilitarian standpoint, you're likely to opt for the lower price version. This wasn't always the case, but we've seen increases in the price of sports jerseys. We've seen increases in the price of branded sports apparel that is outweighing those increases in terms of other forms of apparel. And we talked about elasticity on a recent podcast, the price elasticity of a demand, a new study coming out suggesting that a lot of apparel retailers could maybe push that a little bit further. Well, the one category that they said, hey, things are actually a little bit overpriced here, and it's highly elastic, meaning that demand is going to go down as prices go up, in men's tops, men's shirts. And you look at what a lot of these sports apparel retailers are trying to do, trying to sell men tops or men's shirts. Now, there's a lot more female merchandise in these stores than there used to be, but still primarily, if you walk into a Fans location, for example, probably a good 90% of the apparel is going to be men's tops. This is an incredibly elastic category, and so those price fluctuations, those higher price points, because of what the product is going to negatively impact that. So MLB is going to have to fight against this, really make this more of a destination, and just realize, hey, your retail sales probably aren't going to be super high in this location, but I think this is part of a movement for Major League Baseball overall to address this high single-digit drop in apparel sales and to try and get their products out there on a larger scale. They've got partnerships already with New Era. They've got partnerships with Fanatics. Now it's just a matter of leveraging those as well as their brick and mortar standpoint to kind of turn the tide here.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Well, we've reached the final segment of the Retail Focus podcast, a segment where each Leighton and I look ahead at a story we're keeping an eye on for the next week, month, or year, and we begin with Leighton.
My looking ahead story this week is probably one of the better ones that I've picked out over the last couple of years. My looking ahead stories are fairly weak in general. Sometimes they're boring, sometimes they drone on. But this week, Trent, a piece of news popped out. One of our favorite retailers, Five Below, announced that they're striking a deal with a number of investment companies and a company called Nerd Street Gamers. And they're investing millions of dollars in an esport infrastructure company, which is what Nerd Street Gamers is. This is extremely interesting, Trent. This is a company that has been really at the forefront of value and value innovation and really growth in a lot of strong markets throughout the United States over the past several years. This is a company that not that long ago, a lot of retail analysts were saying they are way in over their head because they're signing expensive lease agreements in these A-class and B-class retail properties, these shopping centers, and these redevelopment areas. But you know what, Trent? The amount of revenue they're able to generate, Five Below is, per store is just astounding. And how they're able to really, we talk about deal flow and the types of inventory that companies like Aldi's Bargain Outlet is able to bring in. Five Below constantly has to innovate season after season, holiday after holiday. They have to bring in merchandise at a certain price point that appeals to the consumer on a consistent basis. And they are doing so, and doing so sequentially better. So quarter over quarter, they're increasing sales, both at a store level and overall company wide. Extremely impressive. So to this story, Nerd Street Gamers, again, an esports infrastructure company, puts on a lot of different activities throughout the United States that involve gamers playing in different leagues, different games, different promotional activities as well. They're going to be using live in-person events at a number of Five Below stores. This is going to be a pilot program that's going to be offered in a number of locations. However, they don't specify exactly how many locations they're going to grow to. They said they could scale to more than 70 locations over the next few years. What does this mean? This means that Five Below will actually use around 3,000 square feet in their stores for what they call local host spaces for these esport events with Nerd Street Gamers. And I think this is just fascinating because you have to wonder why. Why is this my looking ahead story? Well, if you look at some of the statements, the initial statements made by Five Below CEO Joel Anderson, he's saying that basically they're wanting to attract not only new customers to their stores, but current customers who may in fact be interested in some of the tech gadgets they have at their stores, their video game accessories. And you dig a little deeper, Trent, aside from the comments that Joel Anderson made, you look at the current video game market. A lot of people don't recognize this. I saw somebody quoting a research article on Twitter here. On our Twitter, you can follow us at Retail Podcast. But overall, video game sales reached $130 billion in 2018, Trent. Guess how many dollars were brought in from movies? Less than a third of that. So the video game industry is massive, and Five Below is extremely intelligent in terms of being able to acknowledge that and then produce the different items in their particular stores to draw in that younger audience, those millennials and younger that are getting highly excited about the video gaming experience. And this is going to just add on to that. And this, lastly, really tells you the story of how they view their business, because they have gotten into some bigger stores. Their square footage is not to be taken lightly. So for a value proposition, a value store that has items $5 and below, you're already limited essentially because of what you can hold in your different stores. But to be able to really accommodate 3,000 square feet to only draw in more potential customers is, in my opinion, a genius move. And by the way, they're hedging in a way because they're in with different investment firms, Comcast, 76 Capital, Elevate Capital, and an angel investor as well. So they're hedging the bet, and they're thinking about this in a wise way. They're not going to be scaling to all of their stores immediately. This is going to be a pilot program, but they are extremely transparent in their overall strategy and to bring in more customers. They know their demographic, and to maybe broaden their tech product offering to those customers that are going to be intrigued from this Nerd Street Gamers partnership.
My looking ahead story actually has to do with something that took place a little bit ago at this point in time, about 10 days ago, as Mark Tritton resigns from Target to take the reins at Bed Bath & Beyond. And so I think if you're looking from a Bed Bath & Beyond standpoint, the looking ahead is very clear. Can this high-flying executive who did great things at Target, we've complimented him multiple times on the podcast, can he transform Bed Bath & Beyond? And at this point, the transformation is going to have to be more than just the brick and mortar or in-store transformation. It really is about a brand transformation, as we've seen Bed Bath & Beyond kind of lose some of their brand equity over the last 2 to 3 years. They've become weaker in a number of different areas, not the least of which registry and the like, not only with weddings, but also with baby registries at their Bye Bye Baby platform. And, it's a matter of attempting to improve the entire chain. You have some portions of the chain, again, World Market. They were an up-and-coming retailer 5-10 years ago. You saw them popping up everywhere. Now their momentum is slowed. Bed Bath & Beyond's momentum has been slowed for some time. Bye Bye Baby, of course, has a lot of questions that they have to answer. So, again, a tough, difficult job, but for executive that honestly, like we mentioned, has done a lot of great things during his time at Target. And if someone is capable of perhaps engineering the turnaround at Bed Bath & Beyond, it would be him. But my looking ahead story is really, how long will a potential turnaround take? More importantly, I'm going to be looking at their first earnings call, and you can bet we're going to cover that here on the podcast if he speaks, just to talk about some of his vision for the company. So really, I want to know what he's looking ahead to as much as anything. Well, that'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent, saying so long until next time, and we'll be back with you perhaps 7 days from now.
This has been the Retail Focus podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.